Morning, everyone. I'll go very quickly on economic development and outlook. So obviously, and again, stating the obvious, as mentioned by Shirley just now, trade-related uncertainties remain high when we look at these indices on trade policy uncertainty and world trade
Recording
uncertainty.
in progress.
And I think not really surprising because while there were some positives or upsides from the escalation in US-China tensions on trade and tariffs, as well as emerging deals between US and some of the trading partners like UK, Vietnam, Indonesia recently. There's still sort of risk and uncertainties that we need to keep an eye on. Obviously, the main concern is, are we going to see a risk of escalation in trade tension, even tit for tat tariff wars, especially between US and trading partners that are unhappy about the tariff that they will be implemented on 1st of August following the letters from the White House. For example, EU, Mexico suddenly is being subjected or facing higher tariffs at 30%. And also there is this sense that Trump is weaponizing tariffs on certain countries or blocks of countries that for whatever reason he's not happy with, like the threat of 10% additional tariff on BRICS, 50% on Brazil, 100% on Russia and trade partners. And there's lingering uncertainties concerning especially product specific or sector specific tariffs. We saw the unpredictability in terms of the surprise doubling of tariffs on imported steel and aluminum from 25% to 50%. Um, there's going to be a 50% tariff on copper come 1st August. There's a threat of 100% tariff on pharmaceutical. Initially, implementation timeframe for that was 12 to 18 months, but recent statements seems to suggest that it can come as soon as 1st August. And we are still waiting for a decision with regards to tariff on semiconductor and electronic products, including smartphones. But looking at sort of broad indicators, high frequency indicators on economic impact so far. And here we are really paying attention on the Purchasing Managers Index or PMI data on manufacturing PMI. Globally, we saw like what happened in the run up to the Trump 1.0 tariff during 2018, 2019. There was the front loading in manufacturing and trade ahead of tariff deadlines. In particular, if you look at the chart on the right-hand side, the US total imports surged during fourth quarter of last year and first quarter of this year, but slump in April and May. And who knows, there might be a rerun of this front loading before 1st August. So it's going to be kind of choppy until we get clarity with regards to tariffs that countries are going to have to pay to US and also tariffs on products. With regards to services part of the economy, we see softening, just as what we saw during Trump 1.0. This is not surprising as consumers and businesses obviously turn cautious given the uncertainty with regards to trade and tariffs. But I think the services economy is still expanding. The indices remain above 50 to some extent because of mitigation from, for example, interest rate cuts that are happening globally right now. So that's sort of mitigating the downside. So I think overall, in terms of the combined manufacturing and services PMIs, the composite global PMIs, the net effect is that of the slowing growth. At the same time, I think in terms of growth for the global economy, we are looking at it to go sub 3% this year, 2.7% versus average of, I think, around 3.5% or 3.4% last 3 years. The key drivers are unsurprisingly expectation of moderate growth in US and to some extent China, but as well as the continued relative underperformance of other major economies like those in Europe and Japan. And ASEAN would not be spared from the external headwinds. There will be impact on the growth this year relative to last year. Having said that, I think what is interesting to note is ASEAN seems to be weathering the US reciprocal tariff uncertainties and shocks, in particular when we look at export numbers, not as bad as feared. Whether you look at it in terms of total exports or exports to major markets and key export products like electronics. Um, and at the same time, I think another factor that's providing ASEAN with means to weather reciprocal US tariff uncertainties is the fact that this year, maybe with the exception of Vietnam, the rest of ASEAN economies have been on the rate cutting or monetary policy easing mode. Of course, yesterday we had another 25 basis point cut by Indonesian Central Bank. Last week we had Bank Negara cutting rates by 25 basis point as well. And I think what's providing regional central banks the means or space to cut interest rate is because of inflation so far has been benign. And at the same time, our currencies has actually strengthened against the US dollar. Again, maybe with the notable exception of Vietnam, where the dong has been coming down, and that explains why Vietnam so far has not uh, joined the interest rate cut bandwagon that's happening across ASEAN at the moment. Obviously, the interest rate cuts will be positive for consumer spending. Obviously, the biggest component of GDP for ASEAN economies. We have seen even up to first quarter of this year, based on GDP numbers, there's resilience in private consumption in Malaysia, Philippines, Indonesia. But looking at the higher frequency numbers like retail sales, we are also seeing improvement in the retail sales for Vietnam as well as Singapore. And I think the story about China plus one maybe not over yet. Certainly, if you look at the data over the past 1 year, 1.5 year, there's still this trend of the US importing less from China, but importing more from ASEAN in terms of shares of US total imports. And what is equally interesting is the investment impact from all this reshoring, onshoring, friendshoring, and whatnot. The supply chain reconfiguration, the FDI relocation seems to continuing into this year based on the trend in imports of capital goods. And I think in this regards, Malaysia stands out significantly in terms of the surge in its imports of capital goods. I think also maybe people tend to focus too much on absolute tariff numbers, but it's also important to look at relative tariff as well, particularly vis-a-vis China, which I think on the basis of current information, still favorable to ASEAN. And even if we are to look at current tariffs on a weighted average basis, or whether we want to look at it in terms of the likelihood of where our tariffs is going to be based on certain assumptions about whether or not we're going to get continuation of exemptions on some of the key export products, or whether there will be tariffs on specific products. I think generally ASEAN countries, particularly the like of Philippines, Malaysia, Singapore, Indonesia, still hold a considerable advantage over China in terms of tariffs that's being charged by the US. For Malaysia, we are maintaining our forecast of 4.1% growth this year. So that's down 1 full percentage point from last year's average of 5.1%. To note, we have already revised our GDP number twice. First was in April, early April, following the Liberation Day announcement of reciprocal tariff, where we factored in the impact of a 24% tariff comes, I think, 9 July, although that deadline of reciprocal tariff has been extended by another 3.5 weeks, 1st August at 25%. So not much different in terms of tariff that is being, that potential tariff that Malaysia will face come 1st August. But we also still have some time left to cobble up some sort of negotiation and deal with US to get to a better landing as far as tariff is concerned. We also revised again our GDP growth forecast following the release of first quarter 2025 GDP of 4.4%, which came in a bit short of our estimates. So at this point, we just do not see any reason to make further adjustment in our growth forecast. But I think maybe uh, to stress that by and large, the impact on Malaysia's growth this year is largely due to the external headwinds. And I think that is being signaled or flagged by lead indicators like imports of intermediate goods, which have a very good correlation with indicators on manufacturing exports, manufacturing production index, as well as manufacturing GDP. But domestic tailwinds will be key for the economy to stay on growth path. And I think if you look at the quarterly GDP numbers since first quarter of last year up to the first quarter of this year, domestic demand has been a key contributor, not only key, but consistent, strong contributor to Malaysia's GDP growth. And if you look at the breakdown of domestic demand, I think in particular, private consumption and investment, especially private investment, has been the most significant contributor to year-on-year GDP growth so far. I think if we look at the chart on the left-hand side there, that shows you the relationship between retail trade index as well as real private consumption component of GDP, very well correlated, and the signaling year to date is, there's this steady momentum in terms of consumer spending growth. And I think a factor contributing to this is actually we have income growth and we have a healthy job market. Unemployment rate, I think last the first 2 months of last quarter at 3% is even slightly lower than what it was before the pandemic. And I think equally interesting is when we look at the gross contribution to the EPF, first quarter numbers was actually an all-time high, suggesting that we have this combination of job growth that is contributing to the drop in unemployment rate as well as income growth. And the income also is being supported by various measures, such as the civil service pay and pension revision, the minimum wage hike, the increased allocation in budget 2025 for cash handouts. And, who knows, this sort of good news that has been flagged by Prime Minister a few days ago might pertain to additional financial assistance or cash handouts to eligible individuals and households. Also, I think what's supporting consumer spending growth is discontinued recovery post-pandemic of tourism. The other thing that I want to highlight about domestic tailwinds is investment upcycle still intact. Looking at first quarter numbers in terms of investment approval, still maintaining sort of the momentum, no indication of things coming off. Certainly because of the continued upside, particularly in terms of foreign direct investment. And I think by sectors continue to be dominated by technology, which I guess is inclusive of not just electronics, as in semiconductors, but also data centers and cloud infrastructure. I think this year, additional sort of a support for the momentum in approved investment could be JSSEZ impact. If we look at Johor's first quarter 2025 approved investment, 30 billion, it suggests that, the state government forecast of 60 to 100 billion this year in terms of approved investment is realistic. Overall, I think we're also seeing evidence that approved investment are being realized as per the surge in imports of capital goods and robust growth in the banking system financing for industrial buildings, factories, and land. I guess with regards to policy measures, it's especially to mitigate the impact of Trump tariffs on trade with US, and then we need to look into measures like trade deepening and diversifications. I think in ASEAN, there's scope to deepen intra-ASEAN trade. Currently hovers around 22% of total ASEAN trade, and compare that against the ratios for intra-EU or intra-USMCA at 60% and 49%. We are a bit low. Of course, there's whole bunch of free trade agreements being negotiated between Malaysia and its key trading partners such as EU, South Korea, and Gulf countries cooperation. And I think we also need to build on the existing multilateral and multilateral trade agreements and blocks like CP, TPP, RCEP, and BRICS Plus. I think equally interesting, maybe a pitch by us to US in terms of current ongoing negotiation is to address certain issues that has been raised by the US side, and one of it is um, issues of attempts to circumvent US tariff through transshipment to US via Malaysia. I think MITI has announced back in early May they will now be the sole issuer of all non-preferential certificates of origin and PCOs, basically to end the abuse of these NPCP and NPCOs that are being issued by business council chambers and association that were appointed by MITI previously. And the more recent announcement on Monday was effective immediately. All exports, transshipments, transits of high performance AI chips from the US will require permit under the Strategic Trade Act. So I think this is consistent, as I said, with one of the pillars in Malaysia's trade and tariff negotiation with US, which is to strengthen technological safeguards and security. Obviously, the other key policy response has been on sort of monetary policy side by Bank Negara. Of course, earlier on May, there was a cut in statutory reserve requirement. And last week, Bank Negara cut overnight policy rate by 25 basis points to 2.75%, which we estimate can raise GDP growth by as much as a cumulative 0.4 to 0.45 percentage point over 6 to 12 months. Eyes will be on fiscal policy and reforms too. So far, if you look at the value of budget deficit on a cumulative basis, the dotted red line is above the gray line, which represent the trend throughout 2024. Similarly, if we look at budget deficit as a percentage of GDP on cumulative basis, currently the latest figure is first quarter. Again, the dotted red bar there is less than the grey bar, suggesting that we are on track to achieve a lower budget deficit to GDP ratio of 3.8% this year after the better than expected 4.1% last year vis-a-vis the 4.3% target. Obviously, after things like the SST measures effective 1st July, I guess eyes is on these targeted around 95 petrol subsidy rationalization. I think there have been some tweaks back in October last year when budget 2025 was tabled. Government was mentioning about rolling this out in mid 2025. So I guess everybody assumed it could be in June or July. But now that time frame has been adjusted to second half of 2025. We expect right now it could be in August or September. In terms of scope, looks like there's also been a bit of a shift, maybe not so much on excluding T15, maybe much higher level of income to be excluded, probably T5, but one thing for sure, a non-citizen in Malaysia looks like it's going to be excluded from assessing subsidized RON 95 petrol, because just starting with this group of people in the country, government can save 3 to 4 billion. And I think it's very interesting in terms of mechanism. The government is talking about usage of national ID or my card as one of the eligibility criteria. And we also feel that there is additional saving coming from the fact that crude oil price right now is year to date lower than what it was vis-a-vis budget 2025 assumption of 75 to 80 dollar per barrel. I mean, lastly, other key policy lookouts. Second half of this year, 13 Malaysia plan coming on 31st July. National Investment Incentive Framework was mentioned in budget speech for 2025 last year in October, was said to be unveiled in current quarter. Similarly, we understand that Johor Singapore Special Economic Zone blueprint also come up this quarter, and budget 2026 will be tabled on 10th October 2025.